It's 6 o'clock in London, it's 1 p.m. in New York, 7 p.m. here in sunny Valletta in Malta, 1 Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 11, Episode 5, in the aggregate, Episode 65, starts here. Good grief. Well, ladies and gentlemen, Proximity, that's the name of the company that's now part of the solution to the chess replacement fiasco. I'm speaking, of course, of Down Under, where it's the middle of the night in Sydney, but doubtless they'll be picking up on this in the morning when they're watching the re-showings of this on all of our different platforms, Facebook, LinkedIn, and YouTube. Interesting suggestion from the Australian Financial Review within the ASX itself. The obvious person, said Ayesha de Kretzer, who can solve the chess fiasco is none other than Stacey Cunningham, former president of the New York Stock Exchange. That would be an interesting meeting of minds down under to see what she can do with the ASX, where at the moment Proximity are trying to seek to fill in one of the voids that have been left behind by the failure to implement the blockchain solution. Over at Coinbase, well, they had a bit of a comms issue. Unfortunately, this week, they weren't thinking through the consequences of filing their 10Ks et al. And when they mentioned the word bankruptcy, strangely enough, a lot of clients got very, very worried about the well-being of their cryptocurrency. Customers are also suing Coinbase over stablecoin issues, and the shares of Coinbase have dipped as low as well, somewhere into the $50 mark, but people are talking about the valuation potentially being as little as $17 per share. That, I hasten to add, is a valuation that they're suggesting, not where the shares are trading so far, but it's going to be very interesting to see what happens in the struggles of Coinbase as it tries to move forward after a very troubling first quarter results. Elsewhere in the world today, the Hong Kong exchanges. Congratulations to Calvin Tai. All the very best to him after 24 years at Hong Kong exchanges. He's retiring, having been the acting chief executive until recently before the arrival of the new CEO, Nicholas Agazin. He's stepping down from his permanent position as COO. Congratulations to Wilfred Yu and John Buckley, who are now the Hong Kong exchange's co-COOs. FTX, well, the discussion at Boca Raton hasn't quite led the way we thought it might to. So far, FTX haven't been leveraging up to buy the CME group by the looks of what Sam Bankman-Fried's been up to. Nonetheless, it was quite a bit of a zinger of a Senate hearing last week. They all trooped to Congress to talk about FTX's interesting new maneuvering in terms of disintermediation, which seems cool to us, and a new approach to central counterparty clearing, which frankly strikes fear into our hearts. At the same time, Terry Duffy, the chief executive of CME, offered a zinger of a one-liner about the FTX proposal, describing it as glaringly deficient. Salve to a great figure in the parish this week. The New Zealand Exchange was very sad this week with the news that our parish is a smaller place once again, with the passing of Brian Gaynor, a huge promoter of the ASX and the New Zealand economy as an analyst and fund manager over the course of many decades during recent market history. We are devastated, as his co-founder said, and indeed our condolences to Brian Gaynor, the NZX, and everyone in the New Zealand community at the loss of such a pivotal figure in the financial markets down under in the Antipodes. On the other hand, let's finish with an introductory happy note. It's the 9th anniversary week of Exchange Invest, ladies and gentlemen. Who could think that from our birth in 2013, we would end up becoming the must-read every day? Are you not reading, ladies and gentlemen? DM me on social media right now, wherever you're watching this, and ask for your free 30-day trial, ladies and gentlemen, or drop over to exchangeinvest.com so you can get signed up and join the leading figures in the financial markets universe who are the subscribers and readers of this market. Interesting to compare how the world has changed over the course of those 9 years. Here's Young's Pyramid, my opportunity to try and give you a little bit of clear value dispersal and understanding of what's going on in the world of exchanges. CME, they were the leader 9 years ago. They remain the leader to this day. But look at the colossal growth in things like the Intercontinental Exchange. B3 of Brazil, they've essentially been to a degree treading water, although nonetheless, thanks to QE and a great stock market, everybody's value has been pretty much going up over that period of time. However, we've seen some very, very dramatic moves within that pyramid over the course of these several years. None other in market capitalization terms, of course, than, say, the London Stock Exchange, which has gone from a relative minnow in a handful of $1 billion. I wish I had a hand that could hold a handful of $1 billion right now, it has to be said. But at the same time, where they've grown to is some $50 billion over the course of those 9 years in perspective. But again, of course, don't forget, that's been hugely bulked up by the Refinitiv purchase. Refinitiv being a data company. And of course, that brings us very neatly to where we're going to be with our guest in a moment. All these stories and more, ladies and gentlemen, have already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse Business. As I said before, send us an email or hit me up, Patrick L. Young, on social media. No matter where you're watching this, and we'll get you signed up for a 30-day free trial so you can better understand the business of bourses by joining us at the water cooler of the exchange business. Our guest today, Jonathan Bloch. Greetings. Jonathan Bloch is going to be discussing disrupting exchange data internationally. Jonathan is a seasoned businessman with over 40 years experience in information provision. In 1994, he founded Exchange Data International, a London-based financial data provider. They now have over 400 clients at EDI across 3 continents, with office bases in the UK, USA, India, and Morocco, employing no fewer than 500 people. Jonathan has, now there's an interesting and fascinating brace of qualifications, 2 law degrees, and as part of his LLM at the London School of Economics, he studied monopolies, competition, and the law, a fascinating topic for parish discussion, methinks. He reckons he's the only data vendor with this speciality under his belt, and certainly I can't challenge that. I can't think of anyone else who can compete. And this has given EDI, his business, the confidence to be a disruptive force in the industry. Jonathan, good evening from Valletta. The usual starting point. Where in the world are you today?
Good evening, Patrick, and all the people who are watching. I'm actually in London, which is a rare occasion, but I'm here for this week.
Fantastic. So you're in London for this week, and normally you would be based in London, but a man who lives out of his suitcase for much of the year.
Yes, traveling to Morocco, Germany, US, Canada, India, etc. 2 weeks a month, usually, pre-COVID.
Gosh. Well, there you go. I mean, it's quite incredible you managed to get through that. You must manage to have had so many, at this point in time, you've probably got nothing left inside your nose, the number of COVID tests you've taken over time. I was in the Caribbean a couple of weeks ago taking what I hope is going to be a sort of valedictory COVID test. It felt like we were doing a last lap of nasal intrusion. Let's hope that it's all over us now and we can manage to get back to traveling normally. So interesting. I mean, your business takes you all around the world. If you don't mind me asking, without you giving away any trade secrets, what are the sort of things that you're hearing as you travel at the moment in terms of how people are looking at data?
Well, I mean, I think a lot of people are obviously consumed by what's going on around them, such as the war in Ukraine, inflation, and the market taking a tanking. And whether this is a long-term bear market or a short spurt really depends on how quickly the war in Ukraine comes to an end and what happens with inflation. Is this a blip, or are we entering 2-3 years of raging inflation? I mean, people talk about inflation being around about 10%, but looking at energy bills in the UK, where they virtually doubled, inflation is probably much higher than that.
So inflation, a big issue. All of a sudden, that's a data set that people have been looking at that they've been ignoring for the course of the last few years. For a starter, it becomes quite fascinating. So in terms of looking at the market data business as a whole, how do you think that it has emerged from COVID?
Well, I mean, ironically enough, during the COVID period, the data businesses held up very strongly because the markets were strong. And unfortunately, the data business is very much linked to the state of the stock market and people's confidence. When the markets are up, people buy data. When the markets go down, they just freeze. It's also a factor of the fact that when the market is going up, There are a lot of fintech companies being established, a lot of people looking to invest or start businesses in other asset classes that they normally cover, such as bonds and derivatives. And then when the market goes down, they just sit on their hands, waiting for it to get better.
Yes, it's always that fundamental issue, for example, with product development. I mean, everybody talks about futures and options. They're the things that derivatives you can introduce, whether the market's going up or whether the market's going down. But actually in recessions, it's very difficult to launch a new product for the simple reason that no one wants to put their hand up and say, hello, boss, I think we should be trading this, lest the chief dealer thinks that all of a sudden they haven't got enough to do and therefore can go to the top of the redundancy list. I mean, it's a fascinating world, isn't it? So, I mean, obviously, we've got this inflationary pressure. We've got various other issues as we come out of COVID. There was to think that just 2 months ago, we were all very optimistic that the world was going to be in a better place. And that was before Mr. Putin had his slight extravaganza into Ukraine, which has been certainly another dislocation point and obviously a big growth of inflation. When you look at the picture, though, for market data, do you think we're thinking digitally?
Well, I mean, most data is available digitally now. I mean, if you look at the sales of newspapers, they have phenomenally declined. And most data is available digitally. And most data is in databases and can be searched and transmitted. And what we see is more discerning use of data, which is linked to the use of APIs. So you no longer have to take big data sets. What you can do is you could just pull the data you require. And I guess this is also linked to the fact that the cost of storage of data is going to go up as people accumulate more and more data. So people are only going to utilize the data that they actually require rather than just pulling down everything.
Yes, that's a very interesting point, isn't it? Because one would think on the top level, we're sort of communicating the idea that people are consuming a great deal more data, but at the same time, customers are very discerning about what they really want to actually use.
Yes, and I mean, I think one's also, I think two types of users of data. There are those people who use specific data points, and then you get the consumers of big data who take huge amounts of data, apply AI to it or machine learning, and try and discern trends, signals, etc. So in some ways, you have two distinct types of users.
So we have these two distinct types of users, which becomes very, very interesting overall. And certainly, I suppose the easy assumption would be that the massive growth is in the second group of people, aka the people who are buying huge wadges of data and therefore using increasingly better and better machine learning through AI in order to do so. Is that a reasonable assertion?
Well, I mean, I think a lot of the big data and the use of large amounts of data has very much centered on what one would call alternative data, which was data which previously wasn't available for use for particular data points, but now is available because you can discern trends. So, for example, if you took credit card purchases, a lot of people will look at that and see whether they can discern consumer spending trends. For that, you need a lot of data. Just taking a few people's credit card bills is not going to tell you very much.
But at the same time, taking the entirety of, say, a Sunday afternoon's take or a Saturday afternoon's take from Oxford Street in London probably gives us a very interesting picture of the state of at least London and the southeast in terms of what their consumption is at the moment.
True, but you would then have to give it some context. Is it better than the previous week, the previous year? You always got to have some benchmark, some comparative.
Yes, very interesting altogether. And speaking of benchmarks, let me just segue away for a second. We're having a little bit of a big data experience on our feed at the moment. Let me say good evening to various of our regular readers. Hello, Simon Huckle. It's absolutely fabulous to see you once again. Thank you for joining us. Peter Secon, good afternoon, good evening. I hope Ari's beside you on the couch and you're having a great evening between the two of you boys. Hello, Les Calvert. It's lovely to see you all together. And hello to Herculano Fernandez. It's a pleasure to see you. pleasure. And I'm having some form of a problem with, I've suddenly been dropped out of the studio. It's a pleasure to see not just Herculano Fernandez, lovely to see you, but I was just about to say Thomas Carruthers. Tomas, it's great to see you all together. I hope you're in the best of health, whether you're in London, Scotland, or wherever you happen to be in the universe at the moment. I hope things are looking good for you. Great to see you all together, and hello as well. Lovely to see you, Tawfiq Sharif Aldaris. While I disappeared off air there for a moment, while we had a slight technical problem, great to see Martin Watkins already in the studio and asking his first question of the evening. Good evening, Martin. Jonathan Bloch and Patrick Young. Great start to IPO-VID 65. Thank you very much. Jonathan, how do you see the digital securities growth developing?
Well, I mean, that's the million-dollar question, whether the sort of downturn in the last few weeks is terminal or just a mere blip. I definitely see central banks getting into the digital securities market. Whether private initiatives to do so through cryptocurrencies, NFTs, etc., will work out in the end, I'm agnostic. I could see a situation where certainly some of these NFTs and cryptocurrencies disappear into the dust and people lose a lot of money. On the other hand, some of them might survive over a period of time. But it's definitely a new form of storing wealth. And given the fact that people have very little faith in the existing stores of wealth, they can only grow.
Yes, it's very interesting, although at the same time, there's obviously a bit of a design issue in some of them, given the fact that Bitcoin, which was supposed to be an inflation hedge and has proved not to be, that was supposed to be all sorts of a completely contra-indicator and has proven so far not to be, and actually ends up with, what is it, roughly about a 0.7 or 0.75 beta to the stock market, which is really not terribly useful in terms of being an additional thing, because you can buy an ETF for much cheaper and manage to get that without any difficulty. That's sort of a tracking with less tracking error, I'm sure. It's fascinating, though, isn't it? How, I mean, digital securities have come along. How do you think, though, the digital securities business, with all of their smart contracts embedded and so on, does that make a big impact on the data business?
Well, I mean, there's been a huge expansion of data businesses focusing on digital securities. I mean, we've seen a very big demand for data on cryptocurrencies, the volume, the flow, the prices, etc. To be frank, we have stayed out of that market. I think it's a specialist market. I think it's also a market which, as you say, there are lots of problems with the design. It's been subject to a lot of fraudulent transactions, a lot of money laundering, etc. But that's not to say it will stay like that. The future could be very different from the present as regulators and governments try and see how they can exploit this new innovation.
Yes, certainly. And it's very interesting, isn't it, that the one thing that cryptocurrency and blockchain respectively have both done, because they are both unified but separate entities in so many respects, it's fascinating that they've gone through exactly the same path as all other great innovations in history. In other words, they've been reviled, regarded as something that's tantamount to the end of the earth, and therefore, for some reason or another, lots of people think that they've got to be banned, which is as true of the smartphone as it has been true of what the railway. I mean, going back to the 1830s, and the London Underground in the week when the Elizabeth line has just launched, wasn't it run with frosted glass for its first 5 or 10 years because ladies would get a fit of the vapors when they were traveling underground at more than 20 miles an hour. And therefore, so in some ways, there's something to be heartened by. I mean, everybody said, oh my goodness, this is totally dangerous. If they'd said it wasn't dangerous, I think I might have been more worried. It probably wouldn't be such a great innovation. We shall see. Hello, I must say, to Marcus Ward, another one of our regular viewers. Good evening. It's lovely to see you all together. Thank you very, very much for that great first question. We're discussing distributing exchange data internationally with Jonathan Bloch, who, as we've heard, has got offices on several continents and is very closely involved in the data business across all degrees of financial markets. So get your benchmarks in early, ladies and gentlemen. also, if you can, just send us a like or something along those lines. It really helps get us up through the algorithms, which are, of course, the ways that the likes of Facebook, LinkedIn, and indeed YouTube use their AI and machine learning to deliver a big data opportunity to point out the sorts of places you may want to be watching your next video. Jonathan, there's a constant clamor amongst the world of users, particularly institutional users in financial markets. A lot of them, one might say, are banks, and they're always saying data is too expensive. What do you think?
Generally, they're correct. I mean, but they only got themselves to blame. Firstly, they benchmark themselves against a major index. What is that index owner going to do? Year on year, he's going to, or she's going to increase their price. So in some ways, they got only themselves to blame. But if you also remember, the banks and the fund managers in many jurisdictions own the stock markets. But then they got greedy and decided to privatize them. The exchanges are now run for profit. What did they expect those exchanges to do other than to increase their data costs, particularly when there was so much competition introduced for trading by the addition of additional trading venues? So the exchanges couldn't make money on trading, so they turned to data. And often they were the monopoly supplier. And when you're the monopoly supplier, given the weakness of the regulators and the antitrust authorities, you could virtually do what you like.
Yes, it's quite fascinating, isn't it, how the banks managed to work their way into taking their profit early. And of course, also there's been all sorts of politics within the banks on the way that different exchanges ultimately were sold, because banks within trading desks quite liked the position they had and the holdings they had. But then somewhere along the line, when the chief financial officer discovered something that was on his books that he had down for about £4.50 was suddenly worth 50 million, it seemed too tempting to manage to sell. And that has left them with less control of data. But okay, so at that level, clearly there's a monopolistic pricing power that comes from those people who are pricing the indexes and things like that. Are there ways in which the actual process for delivering data is itself remarkably expensive? Can it be reduced?
Well, for many years in the late 90s, I ran a real-time data vendor. And what was interesting, while the unit cost of transmitting the data was coming down, the volume was going up exponentially. So the real cost of transmitting the data always went up because of the sheer volume, which was caused by increased liquidity, increased participation in the market, and increased participants. So I don't see the cost of transmitting data falling dramatically because the volume keeps on going up.
Yes, and it's an interesting point as well, because the way I would look at it is that, I mean, I can recall trading in the 1990s, and the data that you got as an early screen trader when I was a pioneer of these sorts of things in the early mid-1990s was incredibly bare. Whereas these days, you don't actually pay an awful lot more in terms of the absolute money value, and yet you get an incredible amount of dense data accompanying the trading data, not just the volume and open interest, but actually a lot better indications of what's actually been trading, whereas particularly in old open outcry markets, it was very difficult to work out what had really been trading at what particular prices. So the data sets are better. But then, to turn my question around, does that mean that it's become appreciably much, much more expensive to corral, collect, and distribute this data?
Yes, it definitely has. I mean, we just in our small company monitor over 230 exchanges. Wow. And we cover virtually everyone, but we don't cover all. So probably there's 300 to 400 exchanges, and that leaves out trading venues, which we don't necessarily cover. So with just 300 exchanges to cover, it becomes very expensive. And not only does it become expensive to monitor those exchanges, a lot of the exchange data, if you go beyond pricing, is not in English. so it has to be translated into English.
Yes, that's very interesting, isn't it? Because I think, wasn't it Japan that about 6 or 9 months ago actually announced that they were going to be producing a lot more corporate action data in English in order to try and help foreign investors. And when you think about it, yes, the pure numbers aren't so difficult to translate. But at the same time, when you start looking at the trading screens of very rapidly growing markets such as China, well, it's difficult to know where to start or end when you're not someone who's managed to be grounded in Oriental language sets.
Well, I mean, interestingly enough, when the exchanges do translate their data, so if you, for example, you find in the Middle East, the exchanges do translate the Arabic into English, what they do is they summarize the content, which makes it useless because you need all the granularity which goes with the original language.
Yes, that's a huge problem, the absolute danger of the summary. And even more dangerous if they start using artificial intelligence and machine language in order to do the translation for them, because that obviously causes us a huge problem. Sometimes it's very, very good, but a lot of the times it can be absolutely obscenely awful.
I mean, I think you could get a job as a stand-up comedian if you start using Google Translate or some of the other programs. I mean, they're just not fit for purpose for documents which have a legal or regulatory meaning.
Oh, absolutely. And I can think of one from that, which is when we've been transcribing stuff. We love the fact that DB1 is their ticket symbol, the Deutsche Börse. And that, when it's translated, comes everywhere from dodgy boars to a series of things which are quite unprintable and would get us banned from any of the platforms upon which we are this evening. So I totally hear what you're saying. And it's also very, very difficult to pick up the jargon. I mean, are they talking about MiFID or are they talking about the method? And of course, that can make a huge difference between the data that's being picked up. So yes, it does become very, very difficult, doesn't it? So you've got this sort of strange thing. I mean, then again, a lot of the practices in our, for want of a better term, legacy financial markets, they're not necessarily superbly modern, are they? I mean, are they really up to date in order to take on the brave new world of big data?
Well, I mean, I think you have this contradiction. So in the front office, you will have things like low latency trading, where people measure stuff in milliseconds. And then you go to the back office, where they still have mainframes, they still use Cobalt, and some of the systems haven't been revamped for 20 years. And that's partly a function of the fact that traders make money and back offices are an expense item. Also, the regulators are very much focused on the practice of the traders and really haven't turned much of their attention to the back and middle office. So occasionally you will have scandals as a result of that. The other night I went to a talk by Nick Leeson, and he was very revelatory about how he got away with things. One of the reasons he got away with things was because they never did daily reconciliations of the accounts, which you would have thought would have been axiomatic.
Elementary.
Yeah.
You would think that in the late 20th century, somebody would have thought, let's have a quick daily reconciliation of a few hundred million here and a few hundred million there, because sooner or later they were talking about real money, as the old cliche goes. Yes, it's fascinating, isn't it? And actually, Nick is very, very good at discussing these sorts of topics. Good evening, Nick Leeson, if you're out there in the wider world. It was a joy to meet you a few years ago. It is fascinating how still we have so many arcane practices within the legacy financial sphere, yet we also have this Formula One car technology at the front end of low latency trading.
Yes, and I mean, I think probably there's going to be no change in the back offices until there's yet another big scandal. I think that will ultimately motivate the regulators under political pressure to have a look at what really, what's under the bonnet. Because most of the banking institutions and fund managers, their technology at the back office is totally outdated. I mean, they will say to us, oh, we want to use APIs, or we want to have this type of feed, but then they can't utilize them because their technology is too old.
Yes, well, it's certainly very interesting. I mean, I noticed we've got a great comment there coming from Beata Young, who's going to be presenting PhD Positivity Hacks delivered tomorrow evening at midday in New York time. Yes, paraphrasing one of my own comments, she's saying that it's too expensive to use, however, too cheap to ignore it in relation to data and big data as a whole. And certainly I think it's quite staggering, the idea that we're still reliant in so much of the stack for COBOL, which was, after all, devised by Rear Admiral Grace Hopper, who died 20 years ago at the age of about 1.3 million. I mean, I think they carbon dated the woman. Incredible figure, if you don't know about the Admiral Grace Hopper, quite an incredible figure altogether in the development of computing. But nonetheless, it's essentially the same as having a 1952 Ford Anglia plugged into your Formula One team and expecting it all to run smoothly, which is quite incredible. Thank you very much for that comment, Barty. I really appreciate it. So we're talking about exchange data internationally with Jonathan Bloch, the CEO of the eponymous Exchange Data International. So explain to us, Jonathan, a little bit the old Prince Charles question. We're having a lot of royal events at the moment, aren't we, with the Diamond Jubilee coming up in the UK? I mean, what exactly do you do?
Okay, so exchange data, we cover reference data, corporate actions, pricing, particularly closing pricing and evaluated pricing for most asset classes. We cover bonds, government agency, muni bonds, corporate bonds, equities, and traded on exchange derivatives and OTC derivatives. And we compete against some of the big guys, but we have a very different philosophy. And that's a philosophy we're known for. And the fact that we give people very liberal redistribution rights, and we allow our clients to own the data. So should they decide for whatever reason to terminate, they don't have to expunge the data. And that makes us different from the other players. We feel that the practices in the industry are outdated and outmoded. And we have tried to meet what we think are the challenges of data in the 21st century.
Now, there's a big statement, the challenges of data in the 21st century. I like that, the fact that your clients get to own their data, because certainly there's nothing more upsetting than suddenly cancelling your Netflix subscription and discovering that you can't actually watch anything that you've been able to watch previously and you've downloaded. And I'm sure with people, particularly with corporate actions data, it becomes quite catastrophic for their back records and so on. However, where else do you think that there are grounds for improvement in the exchange data industry at the moment?
Well, I think there are many different areas where there can be improvements. And in fact, there are at least 3 or 4 investigations going on at the moment into market data and its usage. So you've got IOSCO, you've got ESMA, you've got the Financial Conduct Authority, the FCA, looking at indexes and credit ratings. And that's just 4 that I know of, investigations. And I think basically users have got to be more discerning, and they've got to use their power as users to get better deals. So if we take indices, a business which we are not involved in, so I could talk quite freely, why do people pay for a brand name when instead they could buy the UK 100? And when I've spoken to people who've moaned about the price of the brand name 100, they say, well, we can't move because we have a mandate. But when a replica index is available, where over a 10-year period, the only difference is 50 basis points, that doesn't make any sense whatsoever. But as what somebody once said to me, nobody brave enters the financial services sector. And people can moan as much as they like about the cost of data and exchange practices, but they have to take action. And it's interesting, the only people to take any action are in Germany, where you've got the BVI, which is the Fund Management Association in Germany, and they are very vocal. And they've been to the EU Monopolies mergers crowd many times, making representations and kicking up a fuss. You also get IPO-VID in Switzerland, which has done something similar. So it's up to really the people in the UK and USA who moan a lot, but always butt out at the last moment.
I think that's an absolutely epic statement altogether, that nobody brave ever enters the financial services sector. I think you've just explained to me what I've been getting wrong for the last 30 years, Jonathan. That's clearly been my error at all points in time, has been to call the odd thing out. I think you're also, it's very interesting though, when you talk about branding and product. The other thing I love about branding and product that always fascinated me was how, though, there is an element of retail investor who get really dazzled by brand, to wit, various academic studies from way back, and indeed a lot of anecdotal evidence. You can look it up yourself if you've got the right data feeds very easily. If you take, for instance, warrants that have got the same time to expiry as an equivalent exchange traded option, the warrant, because it's branded, for example, in Australia by, say, Macquarie Bank, which is a great bank, or whichever, Commonwealth Bank of Australia or something, the equivalent option on the exchange will actually turn out to be cheaper than the warrant, because people perceive somehow or other that the bank-backed product is actually more glamorous. So maybe there's a certain element of that when it comes to the index product.
Well, as one wag said, nobody ever went bust underestimating the intelligence of the public.
Well, that's certainly the way that the tabloid newspaper industry profited over the course of many decades, apparently. So, okay, so it's really, really interesting. I mean, ladies and gentlemen, if you've got a question, we only have 20 minutes to go this evening. We're having a lovely chat with Jonathan all over the wonderful world of data itself. Now, we've talked a lot about the density of data we're getting today. We've talked a bit about how you're seeing, yes, the index product and how that can be improved and so on. Well, you mentioned that there's obviously a huge cost, particularly for you, because you're linked to, what was it, 230 different exchanges worldwide, which is quite a colossal number. I won't ask you to name them all, just at this juncture anyway. What about the cost of effectively creating data once you're actually linked? Is it very tricky, difficult? Are there ways in which that can be improved over time for either the providers or indeed the customer?
Sure. So, I mean, what has happened over the last few years is the growth of machine learning and bots, and as well as artificial intelligence. And we use as much of that as we possibly can. But unfortunately, most of that technology is still not there. So you're very much reliant on human beings. And the same applies for translation, as we discussed earlier. I'd love to use the various translation programs, but frankly, they're not fit for purpose yet. And so we still rely on human beings. And that in the last few years has become, particularly in the last year, quite a difficult phenomena because of labor shortages. I mean, I saw today something which said that Britain has the lowest unemployment since the 1970s. And we see labor shortages in India, in the US, and the UK. And that obviously affects one's ability to marshal more databases, etc. And I wish the technology was there, which in many ways could supplement human beings, but mostly it's still not there.
That's a fascinating message altogether, at the point when the high level seems to be that lots of the media are telling us the huge risk is that everything's going to be automated and take our job away. But actually, for all the wonders of the technology that we have, from the smartphone in our pocket to the laptops upon which we can manage to communicate through this wonderful whizzy interweb thing this evening, that actually there are still huge holes that are precluding the data automation that we could really ultimately reach.
I think that's absolutely right. I mean, what has technology done? It's facilitated a lot more communication, a lot more productivity, a lot more work. I mean, frankly, the economies and industries would not have survived COVID without this technology. I mean, if Zoom and Google Meet and all the others, WebEx, did not exist, could you imagine what would have happened during the pandemic? I mean, the economic devastation would have been phenomenal.
Well, it actually would have just simply been impossible to have a lockdown, which was what happened in previous cases of coronaviruses. Actually, I mean, you saw what was it, the Hong Kong flu? I think they gave the nickname to it in the 1960s, where everybody just carried on working and various parties became incredibly ill and some tragically died because there just wasn't the ability to distance or socially distance in the same way. And we've seen that across so many places, or indeed where we saw with SARS, which was fascinating because that caused a rewriting actually of the whole science of backup facilities, didn't it? Because various banks found themselves thinking they only needed to be 2 miles away, but actually they ended up with their backup facilities still closed down as a result of SARS outbreaks in the likes of Vancouver and other parts of Canada. It is interesting. I mean, whatever we do, it seems the more things change, the more things stay the same, to paraphrase some fabulous French phrase from way back when. So if you look at the business of data at the moment, the technology is there in one sense, but in another sense, it needs to catch up hugely in order to manage to really, really accelerate the processing power. What do you think is the best way that, can this be nudged by regulators, by other parties to move forward?
Well, I mean, governments around the world provide a lot of incentives. So, for example, in the UK, they provide R&D tax credits, and a lot of other countries do that also. But I think it could still be made a lot easier for startups, because tax credits is not the same as giving you cash flow. And most startups struggle because they don't have enough cash flow. And it takes a long time to build up businesses. I mean, my view is that it takes probably 7 years to get a business up and running and profitable. That's based on my experience with several businesses. You will notice that in the last few years, there have been very few new data businesses being set up in the traditional data areas. There have been some new data businesses in the alternative data sphere being established, but very few in the traditional financial sector. Where there's been new businesses started, they've mostly been in the fintech space, where there's been a lot of innovation, particularly around payments, around credit cards, things like Stripe, etc. But there's been very little of people managed to innovate in the traditional data spheres.
Well, and of course, I think that comes back to your great comment about nobody brave just 10 minutes ago, because actually, when you're trying to sell into the institutional financial marketplace, it's an unbelievably long and expensive process of selling. And I can totally get you. I think, well, here we are, Exchange Invest celebrating its 9th birthday. We really only did get into our stride a couple of years or so ago, which is quite incredible. So yes, I hear you there. That's a very, very good point, Jonathan. We have another fascinating question from Martin Watkins has appeared, which I think is very, very interesting to look at. If lawyers are challenged when determining the location of digital transactions on blockchains, what can be done to establish who owns the related pre- and post-trade data? Gosh, there's a question.
That's a very fascinating question. So, who owns closing prices, for example? Who owns prices on an exchange is a very familiar question. And we once were involved in a lawsuit on this. And I'll shortly tell you the story, because who owns the data depends in some ways whether there's copyright in the data or not. And if there's no copyright in the data, then can anybody own it? And can you copyright numbers? Because most of the case law says you can't copyright numbers. So years ago, we had a client in Singapore, and they took a number of closing prices from us, from various exchanges, and we invoiced them and they paid the bill. And the next year we invoiced them and they refused to pay the bill. And we said, why are you refusing to pay the bill? And they said, because you are not an authorized distributor of the Hong Kong Stock Exchange for closing prices. And we said, we don't need to be an authorized distributor of the Hong Kong Stock Exchange in order to sell their prices because they don't have the copyright in them. And they said, well, we dispute that. So the contract was under English law. So we sued them in the UK. And this small Singapore company appointed lawyers and barristers to defend the case. And to cut a long story short, when our lawyers in court asked them to prove that the Hong Kong Stock Exchange owned the copyright, they paid our invoice and paid all our legal fees and settled it because they could not do so. So I suspect that some of those same arguments relate to pre and post trade data, irrespective of where it's transacted, whether it be it on blockchain or elsewhere.
Fabulous. Quis custodia ipsos custodes. I don't know what the Latin is off the top of my head because I was always a lousy student of who owns the pre and post trade data, but that's as close as I can get in classical language. That's a very, very interesting story altogether, Jonathan. Thank you very much. Thank you once again, Martin Watkins, for that super question. Really very, very interesting to discuss the complexity of the market data business. And therefore, I mean, you mentioned the series of investigations that have been going on, have gone on. The FCA had their wholesale market data review. We've seen ESMA in Europe, IOSCO at the global level, and so on. Do you think the regulators really coherently understand either what they need data to do, or indeed what they should be doing in order to try and help that process along?
I can only talk about my interaction with the FCA when they did the original consultation. I spent, together with my lawyer, an hour with the lawyers from the FCA, and they understood the dynamics. Whether they understand what the solution should be is another story altogether, because it's a complex situation, and obviously firms need data in order to carry on their business. And in order for them to get that data, firms need to produce it and they need to make a profit. So you come back to the whole issue, which the Europeans used to describe as abuse of dominant positions, or how do you regulate prices where there's very little competition? And, these are complex issues, but one thing for sure, at the moment, the current system does not work for the users because they feel that they are being held captive and they have very little out. My argument will be that they should be more vocal and should be more challenging, because when I personally have challenged exchanges, everybody behind the scenes has said, very good work, keep it up. I say, well, will you join me in writing a letter to the CFTC or the US Department of Justice? And then slowly, and not so slowly, they melt away.
Yes, white feather repo, as the publishers of a rather pithy newsletter, we feel that often with the number of people who are suddenly very, very brave in the breach, but don't seem to want to put their heads above the parapet at any point in time. Now, the thing though is, going back to this whole copyright area, it's quite fascinating because we've seen some amazing data businesses built up that maybe do or maybe don't own a huge amount of the data that they actually possess. And we've seen the London Stock Exchange, I was mentioning at the start, being an incredible explosion of value over the course of the years as a result of their franchise of buying Refinitiv, which is really the second-hand car market of data in many possible respects. They're not really generating a huge amount of it themselves. Do you think there's a rationalization? I'm not suggesting definitively within Refinitiv, but do you think there's a rationalization within where some of these companies are going to be going forward?
Yes. I think, there are rumors in the marketplace of more consolidation because it's an industry which consumes a huge amount of capital. The question is, who has got the firepower to buy some of these companies that are out there now, because they will go for a very handsome price. I mean, you just have to look what Refinitiv went for. There's always been question marks about Bloomberg. How long will that remain under Mike Bloomberg's ownership? But I mean, who could afford it? It would have to be one of the very few major companies, a Alphabet, a Microsoft, somebody like that. And I was talking to somebody the other day about it. They said, well, the reason why those companies have never really got involved that heavily in financial services is because they find it difficult to deal with the exchanges and the exchange agreements, etc. And it's not part of their ethos.
Pointers, I think, at times when you've seen, are we in the top of a bubble, is usually when we see big tech companies thinking about getting involved in high finance. Famously at the top of .com, I think Microsoft were musing on the idea about possibly getting into the banking business. And we've heard various rumors over time about them getting into the exchange business along with other kind of wholesale data companies and computing companies. Very interesting. I'm going to jump to our final question this evening from the outside world. Hello, Christopher Messina. It's great to see you online. Thank you very, very much for your question. Jonathan, why don't more market participants demand access to aggregated price data as a condition of using the platform in question? There's value in aggregation and packaged analytics. No one questions that. It's striking, the balance between traders and platforms.
You're absolutely right. I mean, but it comes back to the fact that the users don't realize that they have so much power. And if they banded together, they could demand a lot more from the data vendors, from the platforms, etc. I mean, for example, Bloomberg presents people with a contract. You take it or leave it. Well, if the top 10 banks said, we are not going to take it or leave it, we're going to negotiate it, there might be some negotiation. And the same applies to a lot of the other platforms in that. When you have a constituency which is so divided and doesn't work together, that's when people get exploited.
So it's not so much a question of fractional share ownership as factionalization amongst the banks and the different counterparties that's actually causing themselves to have this problem with perhaps paying too much for the data, or how it goes. Which brings us, I suppose, very elegantly, thank you, Christopher Messina, for that fabulous question, brings us very elegantly to the question with which we always love to wrap up this show. Jonathan, we've been exchanging information on exchange data internationally and how that goes forward, and you've got your experience over multiple continents, 3 continents daily, as it were, these days. Where do you think the capital market revolution goes next?
Oh, I think there's going to be a lot of innovation. If you look back in the last 10 years, the growth of things like exchange-traded funds, which have really taken over from active management. There's been a general move towards passive investment through things like exchange-traded funds, which in the US market particularly are much more tax beneficial than other vehicles. There'll be a lot more innovation like that. New types of instruments, perhaps even new types of exchanges, different tax treatments of instruments. So I see continual innovation. Some of it will be related to digital securities, but some of it won't. Some of it will be straight vanilla capital markets.
I think it's a fabulous point on which to conclude today's conversation. There's going to be a lot of innovation, the huge opportunity in digital assets, the huge opportunity indeed in plain vanilla assets, and how that's going to develop the world. Jonathan Bloch, it's been absolutely a joy to have you on the show today. Who owns clearing prices? There's something for you to muse at over the water cooler or over the dinner table this evening. And indeed, we'll probably be carrying on some of that conversation next week with Keith Todd. We'll be discovering more about delivering software as a service, SaaS, through TT, Trading Technologies, of course, not the tourist trophy races. If you're a petrol head like me, I'm going to be dealing with the TT CEO next week. Fascinating altogether. I mean, I love the comment that you made this evening Nobody enters the financial services business, or at least nobody brave enters the financial services sector, as Jonathan has said during the course of this evening. The need for more discerning use of, and indeed the greater deployment of, APIs overall. It's fascinating to look at the ways that alternative data are being melded into the overall picture, but nonetheless, in a world where we've got this incredible big data, artificial intelligence, machine learning opportunity, nonetheless, we still have serious limitations due to the technology, even as we sit here in the white heat of 5G and Web 3.0 et al. On that note, ladies and gentlemen, it has been a pleasure to be here with Jonathan Bloch, the CEO of Exchange Data International. You can check out his firm on the web. I would like to thank all of our commenters and those who asked questions this evening: Peter Secon, Simon Huckle, Les Calvert, Thomas Carruthers. Great to see you again, Thomas. Herculano Fernandez, Marcus Ward, Tawfiq Sharif Aldanis, Martin Watkins, thank you for both of your questions this evening. Bata Young, great comments as always. Christopher Messina, a joy to see you. Ian Miller, lovely to hear from you in the dying moments of today's show. Glad you enjoyed this. We were having a fabulous discussion, despite the fact that there seemed to be a lot of big data chatter from the kiddies in the street below me. Sorry for those slight technical kerfuffles. Ladies and gentlemen, my name is Patrick L. Young. This has been IPO-VID. We continue to promote the revolution in big data, whether we have machine learning or artificial intelligence, or indeed just the wonderful human brain. I wish you all a great week in life, blockchain, and market.